The biggest problem becomes fear of a blank map. You're excited because you've opened up the entire US and you say, I have a clean slate. I can look anywhere in the country to try and find a market that's going to fit my goals. People bring their money from expensive markets to drive higher incomes, and they overpay and they overbuy in these markets. And it creates this distortion of like, what's the actual underlying value for the people that live in those communities.
There's some places where you can find $800,000 homes and super fancy and, 10 out of 10 grade schools. And then there's places where even our property manager will not go.
All right, welcome back to our special podcast series, The 20-Minute Investor, where we bring you actionable nuggets and insights from our real estate investing journeys in bite-sized 20-minute episodes. I'm Aaron Amin. My wife and I built a portfolio of 8 cash-flowing rental properties across 3 states while working full-time and raising a young family.
And I'm Nathan. I'm a husband, father, a tech executive who built a portfolio of cash-flowing rentals across 2 states from over 2,000 miles away.
Together, we co-founded the Remote Real Estate Academy, where we coach investors how to build their own portfolio of cash-flowing rentals from anywhere in the world. This week, we're going to jump into a fun topic. So we have a email course that kind of goes over the biggest mistakes that new investors make when they're getting into out-of-state investing. And so what we wanted to do in this next few episodes is actually dive a little deeper into each one of those mistakes. So the first one we kind of talk about is the idea of kind of neglecting or skimping on your market research when you're going to pick a market. So specifically, the reason investors fail to thoroughly research the market they want to invest in, why that leads to low or potentially no appreciation, depending on their choice, higher vacancy, and a riskier tenant pool. And then, of course, our thoughts on potentially how to fix this or be a little better at it. So let's jump in. But Nathan, you have any cursory thoughts on the matter?
That's a good topic. Tough one. Market selection seems to always be the first or the biggest or both stumbling block for anyone getting started. I don't really know where to take this because we could take it so many different places, but I think it all starts with understanding your goals. We've said this a bunch of times. It's not news, hopefully by now, right? But oftentimes one of the biggest mistakes that I see is, people starting to look at or research, even cursory research, markets that don't even fit their goals. By that, I mean, for example, maybe a stereotypical and easy to conceptually understand example is like if you want to invest to get some monthly cash flow into your bank account, you start looking at, markets like New York, Boston, San Francisco, Los Angeles, right, on the coasts. And that just doesn't map to your goals at all, right? So yeah, I would start with that. What do you think? I know that's the thing I see first, almost always and all the time. And then we could get into like a specific market. Let's say you've identified or found 1 or 2 markets that more or less align with your goals. Then there are other issues that come into play.
Yeah, I think there's a few kind of dimensions to this, right? The first is when somebody starts considering out-of-state investing, that usually means they've already started to kind of strike out in wherever their backyard is. So Nathan and I think we were originally bonded by the idea that we lived in high cost of living areas where it didn't make sense to buy rental properties. Even though even with a strong household income, it still doesn't make sense to invest in certain markets, especially if one of your goals is cash flow. Like you mentioned, all those coastal markets. I don't know how you can make a rental property work, especially at today's property prices and interest rates. So I'm going to go ahead and assume that most people that are looking at out-of-state investing have already kind of come to the conclusion that their market might not work for them. So then the biggest problem becomes what I kind of think of as fear of a blank map. It's like, okay, in one hand, you're excited because you've now opened up the entire US and you say, I have a clean slate. I can look anywhere in the country to try and find a market that's going to fit my goals. Well, that's overwhelming, right? There's decision fatigue around that. If I can pick anywhere, how do I know where to pick? So then when you start applying this filter, I think for me, I can speak only really for myself here, but my wife and I had a similar issue where we had invested in our home market when we lived in Las Vegas. Then it got too expensive to invest there. We moved to Washington. We invested in our home market in Washington. Then it got too expensive to invest there. So it kind of forced us to go start looking at other markets. And we hit that same decision fatigue. We landed on an area called the Quad Cities in Iowa. But before that, we were looking all over the Midwest, all over the South, the Great Plains, all these different cities. And we didn't know one from the other. It was really hard for us to understand, having been new at out-of-state investing, even what to look for. So I think there's a degree of also being a little impatient and just wanting to get to a destination that sometimes people barrel through and they say, oh, Oklahoma City looks nice, right? I see that they have houses for $150,000. Zillow said that it can rent for $1,200. Like, great, let me just go to Oklahoma City. And they kind of just like transpose what they want what they want to see into a market that they're looking at instead of actually like going through the process of selection. So I think that like the analysis fatigue, if you will, of trying to like figure out like where it fits with, if you don't have good guidelines and parameters, then you're either going to make a rushed decision or potentially an uninformed one. So I think it's the
Would
idea
you
of like how do you create the right parameters and the filter with which to look at different markets.
would you call it again the open map problem?
Yeah, like fear of a blank map, basically.
Fear of a blank map. Yeah, I love it because I think what I've seen happen as well is like exactly to I think basically what you're saying was like once you've, let's say, eliminated the coastal markets because they don't produce the goals that you want or the cash flow that you want, and then you kind of open up the entire map of the US. You find hundreds of thousands of cities potentially, right, where you could go invest. And oftentimes I see people will pick any city because like, oh, look over here, this city has houses for $75,000 that'll rent for 900. I'm above my 1% rule. Great, fantastic, I'm going to go there. But what they fail to think about in their market research is that city, it has 10,000 people living in it, one employer, and that's about it. If that employer goes out or moves or shuts down or whatever it is, then there's nothing, right? Or just like 10,000 person, location or city has one property management company there. So you're forced to work with them. So oftentimes I see kind of that I think what you were saying, people rushing into, well, I could pick anywhere now. So I'm just going to pick here because Zillow has cheap houses there, but they don't think about the rest, which I think is part of like that next step, deeper market due diligence that we're talking about here.
Yeah, and I think the people start to think of deals only in the terms of spreadsheet math. Like if you look, you could pull up a house in just about any market in the Midwest and other than the major metro cities, and you can probably find houses that are much more affordable than the average house in a coastal market. And there's just also like there's just relative I don't know what to call it exactly, but basically when you're conditioned and you grew up in a coastal area or you live in a coastal area and the cheapest single family house that you see within 20 miles of you is $700,000, and then you start Googling or Zillowing in another market in the Midwest and you see that they have a house for $200,000. $200,000 feels cheap to you when everything around you is $700,000, but to the person who grew up in that city, $200,000 might be wildly overpriced. So what also happens is that people bring their money from these more expensive markets and where they drive higher incomes, and they overpay and they overbuy in these markets, and it creates this distortion of like what's the actual underlying value for the people that live in those communities. And I think that's another kind of interesting trap that people fall into, is that they convince themselves relative to where they're from, this should be, this is a deal. But they're not really translating it to what the actual local market provides. And so that's another kind of trap I think I see people fall into. And I say people, I fell into it as well. Like I was totally lured in Iowa thinking, and the houses we bought, thankfully we bought them at reasonable prices. We didn't like wildly overpay, but we did certainly think that they were better deals than they actually were just because of our relativity. So that's one other kind of thing that comes to mind.
Yeah, and I think just pulling on that thread as well, and maybe you touched on it kind of implicitly, but you talked about how those $200,000 homes might be larger efforts, bigger value for the local people who live there and purchase these homes. But what, I don't know that you said this explicitly, but one thing that we see as well when you're bringing your coastal money or coastal money mindset, where your homes are $1 million a piece, and you see these properties for 200,000. If you don't do your homework and due diligence on the particular market, you don't actually know if a $200,000 home is overpriced, underpriced. Is it $200,000 because it has all these issues and every house around it's $400,000, or the opposite? Is this one just super overpriced and it's listed at 200,000, which seems like nothing to you, but every house around it is $100,000? Obviously, these are hyperbolic examples, but you need to do your due diligence to understand, what the kind of average, property value is for the type of property that you look at in your market. And that's, yeah, like I said, that's, directly related to like this skewed price point view or whatever that you might bring from the coastal market that people need to be aware of.
Yeah, 100%. And you kind of alluded to this earlier, right? So the 10,000 person town that has no diversity of industry and has maybe only one or two property managers, unclear if they're good property managers or not. You can be too indexed and too dependent on one or two things. And that can, when you talk about preserving your wealth, so let's say you find a house that fits really well. It fits your buy box from a pricing standpoint and an investor return standpoint, but then you have trouble finding somebody to manage it and you live halfway across the country and they're not taking as good care of the maintenance. So deferred maintenance ends up costing you more than you think. They can't find good tenants. You end up with evictions or people paying late. All these operational problems where maybe that thing looked really, really good on paper, but you're actually ending up with a kind of a painful investment where even if you bought it for $70,000 and it rents for $1,000 a month, well, that doesn't really matter if you can't actually collect the rent or you can't find good, stable tenants and you have, repairs and issues going on all the time. So I think there's that element too of like, there's what it looks like on a spreadsheet, like it might perform in the first, 1 to 2 years. And then there's the actuality of owning and continuing to operate these homes for the long term, which is what most people listening to the show are planning to do. Buy and hold long-term investments, when done out of state, need that continuity and that management and that consistent oversight. I don't know if you have anything to add there.
Well, yeah, the thing I wanted to add is like we've been talking about this, 10,000 person town with the 1 or 2 property managers, but that actually is true and can be extrapolated to every person on your team member. You're in this small town where there's really only 1 or 2 plumbers and 1 or 2 roofers and 1 or 2, insurance brokers, at best. And then you find yourself in this situation where, every time for everything, you're running into roadblocks. People aren't available to do some form of repair or rehab work that you need, or they will just have the one price quote that you can't negotiate because there's nobody else to pit them against. And so there's all these operational aspects that need to be taken into consideration before getting started.
Yeah. Yeah. And so 10,000 person town is an interesting example because I don't think we don't focus on those types of areas, and neither do most of the students and people that we've worked with. But you're right, like that stuff can also apply in bigger markets, and even the team and the people that you have to build. There's like inherent checks and balances that don't exist if there's only 1 or 2 people. Like they don't have that, if they don't have that many people to compete with, then the quality of their service, the quality of their oversight, and the way that their attitude towards how they serve their clients is different than if there's 20 people that they're competing with for business. It kind of forces a certain standard, or at least it should in theory, business principles. But yeah, I think so. The tenant selection is another interesting variable to kind of look at. So obviously the type of city you invest in and the types of industries that exist there, the types of jobs, the median income, all these stats that you can kind of at least get a broad stroke picture of who lives there is one element, but also the area within a specific market. So, the Class A, Class B, Class C, and Class D neighborhoods within a large city could have completely different dynamics, within the same market. And so that's another area where I think when people say, oh, I want to invest in St. Louis, well, there's different parts of St. Louis, right? And
perfect example.
Yeah. So maybe you can peel it back there and like how people can be a little more specific and figure out which parts of a bigger town they might want to invest in.
Yeah, I mean, I think you basically touched on it or said it all, right? It's like, another stereotypical kind of speed bump, roadblock problem, whatever you want to call it, that people run into is like they'll pick quote unquote a market, and that market is, as an example here, St. Louis. St. Louis is a pretty massive city. I don't know, it's top 15 largest cities in the country or something like that. Probably wrong on that, but it's big. And when you say I'm going to invest in a market, St. Louis, in this case, an example, St. Louis has a lot of zip codes, a lot of neighborhoods, a lot of different areas. They're not all the same. And it's just like what do they always say in real estate? Location, location, location. I mean, that's very, very true, right? When you pull up a map of, quote, again, a market or a city, there's a lot of different places. And to your point, some are probably lower end or, some are higher end. Again, I'm more familiar with St. Louis because that's where we have most of our portfolio. There's some places where you can find $800,000 homes and super fancy and, 10 out of 10 grade schools, right? And things like that. And then there's other places where even our property manager will not go. For example, right? Just because they're so rough and there's theft and, crime and all of that. So being familiar with that is critically important. And talking to local investors, your team locally, property managers and whatnot to get that information is critically important. And then once you know what we want to call it, because it's not market anymore, but like the submarket or the areas you want to invest in, stick to those, right? And, zero in. And like, for instance, for us, think we've been looking at 5 zip codes in the however many St. Louis market, quote unquote, has. We've been looking at 5 for the last 7 years, I think. And those are the only ones we look at. And we know them like the back of our hand at this point, and we know which streets not to cross because things get rough. We know which areas and zones in those zip codes have the better school scores. So yeah, that's another trap to be careful for. Yeah, I invest in Indianapolis. It's like, well, yeah, Indianapolis is pretty big.
Yeah. So, and it's also a mix, like what you just described, of qualitative and quantitative information, right? If the only thing you look at is metrics, you're missing a big part of the picture, because metrics don't necessarily tell you, when I cross this certain street, I get into a very different part of town that has a very different profile. And like you said, sometimes there's streets where your property manager won't even cross that street. But if you're pulling comps, or if you're using a tool like a Zillow, or even some of the other tools that we use, the comps are very imperfect, because if it's set to pick up within 0.5 miles, but you cross that street, this hypothetical street, it might be giving you information that suggests that this area is the same when it's actually not. And so that's where also knowing your market and correct me if I'm wrong, Nathan, but you've never been to St. Louis, right?
I have not, no.
Right. So the ability to pick up that kind of street level local knowledge without actually visiting, that's obviously one of the skills that we try and teach, but it is possible, but you can't ignore the qualitative parts. Like if all you ever looked at was data and you never bothered to like talk to your property manager, talk to other local investors, and like engage in every way you can without being there to learn like what those nuances are, then it would be impossible for you to make a really informed decision, because you would just be going with numbers and without any of that extra stuff. And at the end of the day, these are houses. This is people's homes. This is where they choose to live. People pay rent in exchange for the shelter, and they want a certain thing out of it. And if you're not kind of aware of what you're offering and what you're offering can support, that is an incomplete picture that can lead to a lot of problems down the road. So we got a couple of minutes left here. I think, any final threads to pull on market selection, particularly maybe looping back to this fear of a blank map. If somebody is kind of stuck and they're excited because they have so many options, but they're overwhelmed because they have so many options, what do we think they can do?
I was once given this advice or pro tip, whatever you want to call it, that I've personally always adhered to, which I love, is like look for cities that have a major league sports team, NBA, NFL, NHL, MLB, whatever it is. Typically, if those businesses operate in a city, the city is large enough to attract, enough population and therefore enough business and diversity of tenants, property management, corporations, all that stuff. So that's always helped me. That's maybe a pro tip that I can't remember who told me that, but I like it and I still apply it.
Yeah, I know it sounds simple, but like I'll use Las Vegas as an example. It's always been thought of as this big tourist destination. There's a lot of money that comes into the city, but as a result, it felt very over-indexed on hospitality. Let's use COVID as an example. The Strip shut down for 3 months almost, and the whole city, the unemployment was 27%, and like everyone was basically struggling to eat, even with some of the government aid that existed. It's an extreme example, but the idea is that, the city is thought of as completely indexed on external visitors. But over the last 7-8 years, they had pro hockey come, they have NFL come, they're likely going to get an expansion team for NBA, and they also have MLB coming, and they built multiple new arenas, right? And so you can see they're attracting a different type of attention, a more permanent cultural fixture. And that's a signal of a growing economy. And as a result, Las Vegas, the property values have grown dramatically. So that's just one example of how that could play out. And then, the population growth, I think that's another one not to ignore, a really high level indicator.
Of course.
That, it can be a trap too. If you look at a city that's got, very favorable return metrics, but the population is declining, you got to just extrapolate that trend. Don't just look at the first 2 years. Oh, I'm making 8% on my cash. What's it going to look like 10 years from now if I still hold? So that's about all we got time for. Another 20-minute episode in the books. But if you have any thoughts on the matter, or if you want to engage with us, feel free to drop a comment or shoot us an email, and we'd love to hear what you think. We'll catch you next time. Thank you for making it to the end of today's episode. As you may know, podcasts are very difficult to grow organically. If you're getting value from today's episode, I'd deeply appreciate if you can take 30 seconds to leave my show a 5-star rating and review. This will go a long way to helping me reach more listeners just like you. Thank you so much in advance.